Hello and welcome to the Mortgage Conversation with Saffron for Intermediaries. I'm your host, Tony Hall. Another wonderful guest panel today, and I will ask them to introduce themselves in a few moments. Before we start, I just want to say that we're recording this on Wednesday, the 15th of April, so anything that we say will be before or up to that point. And I will also say that any of the comments that we make today are our own and not necessarily those of our employers. So let's meet our guests. Well, welcome to my co-host, the man who needs no introduction, Mr. Lee Williams.
Hello.
How are you?
I'm good, Jim.
Good, that's nice.
Nice
Delighted.
chat.
Anyway, right, so I'm delighted to extend a big The Mortgage Conversation welcome to a first-timer and a seasoned friend of the show. So let's start with you, Simon. If you could just tell our listeners who you are and where you're from and what you do, that would be wonderful.
Yeah, of course. So my name's Simon Walkland-Knight. I am the Supported Network Director for John Charcoal. A little bit of history about myself. I've been a broker for over 20 odd years. I currently look after about 120 self-employed mortgage advisors who all look to us for support in terms of lead support, marketing, things like that.
Excellent, thank you. And lastly, Martin, welcome back.
Thank you for having me back. I obviously didn't disgrace myself the first time too much. Martin Reynolds, CEO of Simply Biz Mortgages and FIBA Chair. I've been in the industry 30 plus years, we'll leave it at that. Worked on both lender side, insurance side and distribution side.
Wonderful, thank you. Well, welcome everybody. So the title for this episode, which probably should be no surprise to anybody in the mortgage market, is we've called it The Pivot Point, the Mortgage Market 2026. So let's move into our first topic. And this is all about the geopolitical shockwave. So obviously a few things are going on in the Middle East, thanks to some nice people, which has somewhat derailed 2026 in terms of recovery, all the positivity. I suppose the context in March, the market shifted from anticipating rate cuts to fearing triple rate increases due to energy-driven inflation, cost of living, etc., etc. So I suppose we're looking here as a reference point of an article in The Guardian around the Iran war may increase mortgage payments for an extra 1.3 million households. So let's start with Simon. So what are you seeing? What's the position? We've seen 1,500 products pulled in a matter of weeks. So what's your thoughts on all of this madness?
So I think what has happened, and I think one thing that it's important to do is separate us from what's happened in the past. So obviously this is something that's been going on for maybe the last 6 weeks. We've seen a huge amount of products being repriced. Now, obviously we've had similar events like the mini budget back in 22. But I think it's a very different proposition now. I think at the time, back in 22, there was a lot of panic in the market. Lenders really didn't know where the swap rates were going to land.
A lot's changed, to be fair, to be honest.
Yes.
We still don't know now.
Right, okay. But I think,
do carry on.
I think the changes have been a lot more considered this time. I think previously there was a lot of panic being driven within the market. Obviously, we saw huge increases at the time. And yes, rates have increased, but not to the extent that we did back then.
So, Martin, what's your view on this? Have we got near to mini budget 22, or is it, to Simon's point, is it a bit more measured?
It's definitely measured, and I think there's lots of different reasons. I'm always wary of hyperbole of the media. Because it's the headline, isn't it? So is there really 3 base rates built in? Because swap rates are going up and down that quickly that there might have been for 20 minutes. Yeah. So I think we need to be calm and considered. I think structurally it's different. Rates were going up anyway pre the mini budget. They just got there a lot quicker than we all anticipated post that budget. But I think we'd have ended up at that point anyway, but it would have probably took about another 12, 18 months than it had to. So I think at the moment, structurally, the market was going in the right way. We expected base rate to drop. People are working on that theory. Yes, this is a blip. And and we may have a base rate rise. It depends where inflation goes, which I'm sure we'll talk about. But I think once there is a settling and a confidence of where we are, I think you'll start to see rates start to drop down. Not quickly, because as with most things go up quickly, but then take a little longer to come down. But I think they'll start coming down again, and I think it'll ultimately still be a positive year for the broker market.
Yeah. So just on that then, so how, I agree with you on the positive side, but how are customers, I suppose, Simon, I'll come to you on this, how are customers reacting to this environment with the brokers that you're looking after, etc.?
Well, I think with obviously the increased media coverage, they're very aware, very price sensitive. They're concerned about potential cost increase in terms of energy, fuel, general cost increases. And the one thing that has really changed from before the Iran war, we were in a sort of a rate falling environment at the time. People were really waiting until the last minute before they secured any rates. There was no real compulsion to get anything secured. Now people are doing making decisions as quickly as possible. And I think the one thing that as brokers we need to do is make sure that we communicate the importance of getting the process done as quickly as possible, because the rates may not necessarily be around for as long as they had been previously.
I don't think you can over communicate with customers.
No,
I
sure.
think that's the bit. And communicating doesn't mean selling. Communicating just what's happening, letting them know this is why rates are moving. Don't worry about it. But I think you're right. And I always work on the premise that, and we all do it in our own personal life, we try to guess the rates, and you don't know whether you've won or lost until after the event. So I'm always very mindful, especially on a purchase. Have you found the house that you like? Is it at a price you can afford? Is the rate that you can afford? Buy it. Because if you wait, the rate might go up, you might lose the house, and then you're starting again, and you'll always have that niggle. I didn't get the house I wanted. So for me, it's always about work on what you know now, and don't try and predict what's going forward. Yeah,
we'll come on to that in a bit around the next section, talking about who's doing what in the market from what we're seeing. But Lee, so how from your view, as a lender perspective, how have you seen brokers respond to this environment?
I think that although we ignore the previous, I think the previous has helped in the sense that a lot of brokers now are very resilient. They're very aware that things can change quickly, especially if they've been in the industry for a while. They've had to have conversations previously that's more than just, do you want a 2 or a 5 year? Which is what we found previously was, there's loads of variable rates. How do I discuss variable rates? Because I've been used to being able to discuss, do you want a 2 or a 5? Because there's only a marginal difference. Now there's a lot more advice going on, I think, even around the product, the affordability side. So I think that over the last few years, that's basically created such a strong foundation for brokers to deal with these changes, especially when they're completely out of their control. And the good brokers, like you just mentioned, are those that will not be scared to communicate.
I think there's two bits for me. There's the bit that's still frustrating is that a lot of lenders still haven't worked out how to give brokers enough notice. Some have now. Some have come out with their what they're going to do. We all get that there's pressures, but I think if you follow it through and the broker sits in the middle and it's getting all the information from the lender going, rates are going at 5 o'clock today or 6, 7 o'clock today, get it at midday. They've got a client bank who were looking at that rate. They have to ring that client and go, you've got an hour. So the worry, if we're not careful, is do you put all those people as vulnerable clients at that point because you've just given them an hour to decide. And also the feedback we get from some brokers is some customers think then it's pressure selling.
Exactly.
Yeah. And the broker sat in the middle going, well, I'm the messenger, I'm trying to help you, but he's getting that feedback from both sides. And I still struggle as to why lenders can't give longer so that we can have better considered conversations with the client at the end.
I think it's funny because when we were removing our products recently, we don't have an overt statement like Coventry. Coventry, the industry darling, with their clear 48 hours notice. Ours is more, we try to give 48 hours, and we generally do, but sometimes we can't, but we always aim to give a minimum of 24, because I think that's in that scenario. And I had that debate with our pricing committee, who were looking to do something close, not quite 24, and I said, you've got to remember there's a client at the end of this, and a broker sat in the middle. It's a commercial decision for us, so I agree with you. Back to the lender point, it depends, but sometimes the margins are that slim. Us taking another 10, 20 million on that product, we're not making any money, and we've just burnt 20 million of capital for 5 years for nothing. So that's why we sometimes it happens. I agree with you that you've got to sometimes take that hit, and that's what we try to do. But that's one of the reasons lenders will pull, is commercially they're underwater. It's such a tight competitive market anyway. The margins are slim, and when the swap changes, it is really challenging. But we, as a lot of lenders, always try to give at least 24 hours notice.
Yeah, I think we all get the commerciality. I suppose there should be enough data around that people have within their organisations of what happened last time we did this, what was the upflip, what was in. So knowing that you go, well, actually, we might need to go and tell people at 5 o'clock tonight, it's 5 o'clock tomorrow, because we know what we're going to get, because historically these are the spikes. And I think that's the bit that we'd like lenders to work more on,
which is our approach. That's how we kind of said, well, we know what we're going to get, so we know what we're going to expect, and therefore we have to tighten the belt on this lot, because we know we're going to have some that's not going to make us any money, but it's the right thing to do. So I think you're right, that commercial side. Anything else on this subject before I move on to the next thing, which is very linked to this?
I guess one question I would suggest is, especially for the smaller lenders, is there any option to potentially price slightly higher to give you a little bit more margin, especially where the products are being recommended based on criteria as opposed to price in a lot of scenarios, with the option to then reduce that price at a later stage once things stabilise?
Absolutely. And pricing is a obviously very well used tool for people to manage volume. However, there's a little thing called consumer duty that says you shouldn't really use price as a lever. If you don't want the business, don't have the product. Is it fair for a customer to have to pay more because you don't want it, even though they want it, if that makes sense? So it's a balance. Obviously, we're in that niche. We're a specialist complex lender that lives in those niches. So we're not reliant on price. Prices are the least of our levers. Interestingly, our brokers have said recently, haven't they? We don't care about the prices you're coming back in. We just want you back in. We want solutions. We're missing the solution front. But there's a danger, isn't it, of whacking a price on, because if a customer needs it to the point Martin was saying, right, I'm ready to buy, I'm buying, is it fair in that scenario? I think it's a balance, isn't it?
Sure.
I think also it's from the conversations I've been having with some of the brokers that have been really adapting well to this market. They do have that conversation, I find, in that first meeting about what's going on in the market and the fact that these things can happen. So it doesn't feel like it's pressure selling in some ways. It's not them saying you need to do it now or that's going to go, because they're saying that they've already preempted that conversation and where the market's currently at. So we've had a few saying, look, obviously as soon as it's out, let us know. It's more around criteria, like you say, for those that that are price orientated, having that conversation, because that there may be a lender or two that gives you a couple of hours. At least then the customer's aware, rather than feeling like it's come out of nowhere.
I think if we're obviously if we're having a little product that lenders do, it's always good to give a positive. I think we've seen less lenders suffer with service issues this time around. Some have,
absolutely.
But last time, everybody did. So I think that there's a good lesson there. I think the challenge we've got moving forward is when it does settle, stabilise, and maybe rates stop going down, how much of the records that everybody wrote in March is going to have to be rewritten, and how many times, and what pressure does that put on the broker, and also the lender then to keep on doing it, and also you've bought money at those other rates, etc. So I think even when it stabilises, it's not the end of the challenge.
No, No, it's not. Pricing in today's mortgage market, I wouldn't want to do it. I feel sorry for my colleagues that have to, spend their days looking at it because it's really hard. You've got to have a magic crystal ball, and even then, it depends on what the crazy guy's going to do tomorrow. That's the world we live in.
Yeah, absolutely.
Right, let's move on to some more, very much linked to this, but that's around like the pricing paradox and the house price slump. So, constant repricing. I think the average product life now is 8 days.
Yeah.
That's what it's changed to. I think before it was it was weeks. It's now 8 days. So for brokers, it's you got to convince a client, if you want this, do it, because it's probably likely statistically not going to be here. So we've got constant pricing changes, and then we've had a 0.5% drop in house prices according to the Halifax Index in March. So rates have jumped. I think we're all seeing rates jump, but the reality is they've just gone back to where they were a year ago. So they're no more expensive than they were a year ago, but that's the progress we'd made in the market that's been eroded overnight. It's in just 30 days. The average 2 year has gone from 4.8 to 5.9. So those sub 4% rates are gone for a while, I think.
Yeah.
So I suppose, is this the correction we've needed? What's the impact? Martin, I'll come to you first in terms of all this.
I don't think there's a correction. Probably got me on my hobby horse now. House price indices, don't like them. I think they're great marketing tools for the people that do them, and fair enough. But obviously, that's based on the business that those institutions have taken in that month. So again, it's going to be dependent on their volumes, their pricing, their regionality, etc. So probably the best house price indices, if we have to use one, is land registry. But then that's 3 months out of date.
Yeah.
So you're working in arrears. So I just think that they create false optimism and false reality and false problems if we're not careful, because obviously the press will come out and go, house prices have dropped, at this, and people, hang on, what's happening? But even when they go up, people then have got the expectation, my house has gone up 3%. Well, no, it hasn't. The average in your area has gone up 3%. Do you have an apartment? Do you have a terraced house? Do you have a semi-detached? Do you have a detached? What street are you on? But as a consumers, we'll go, oh, my house is worth more. It might not be, or might not be as much as that. And I think that creates problems and challenge, and then everybody focuses on it and builds around it. And so I don't like them, if I'm honest, but I know people do. But I don't think we're going to get corrections. I think what you might get is prices not go up for a while.
Yeah.
And it stabilises, but I don't think you're going to get a correction because we don't have enough houses.
No, absolutely. Simon, what's your thoughts?
Yeah, I think it's important to bear in mind that as much as there was a 0.5% reduction in March, that actually overall in the last year it's increased by 0.8. So there are fluctuations throughout the year because of seasonality anyway, and quite often it's a case. You can always find the right statistic to prove your point. But I think, as Martin was saying, I think it will just lead to a period of maybe reduced growth. But there are still intrinsic problems within the UK property market, lack of supply across, all areas. Yeah.
For a lot.
So I think we're always going to see that increase.
I mean, it's interesting, Lee, I'll come to you in a second, but what we're seeing is an awful lot, to your point around indices creating the wrong impression, because averages always create an issue, don't they? Because there's always a winner and a loser. We're seeing a lot of down valuations currently because of this expected value versus the reality. So that's definitely a challenge in our world. People are overinflating the price of their house, probably due to an indices.
Is it a down valuation or an appropriate valuation? We own a surveying business. I'll stand that one out.
Exactly.
But you've got to be mindful. It's back to that point, isn't it? Somebody thinks it's worth that, but it's only worth that if somebody's buying it.
Yeah.
If you're
most
remortgaging,
of the issues are because of expected value, not house price.
Yeah.
So it's a remo value rather than a purchase value, if that makes sense. But we're seeing quite a bit of it. Lee, any thoughts on this?
I think valuations on properties are really difficult, especially if it's a remortgage. There's a lot of emotion that goes into it. A lot of customers turn into valuers based on what they've seen in the market, potentially not what's been sold either. It's what they've seen go on the market, right? Ours compares this way, but doesn't compare the other way. You know, it's a difficult one. But I think from a market point of view, like anything, there's always winners and losers. There's an opportunity at the moment, I think, for those that are in a proceedable position. To look for, like you mentioned before, if you've got the right property and you're looking to buy something and it's at the right price, you know, if you can afford the monthly payment, the market shouldn't really be impacting that. And I think that's the key thing. But yeah, emotion's always hard when it comes to someone owning their property saying it's worth this.
Well, we always think our house looks better than somebody's two down, don't we?
Absolutely.
Who might have sold and go, oh yeah, but we've got this and that, and it looks like that, and we
That's
all
what I
do
mean.
it.
Yeah,
we
yeah,
all
yeah,
do
absolutely.
it.
Absolutely,
We're all house
It's-
snobs.
It's an emotive, but I think the cohort that we're seeing is more the buy-to-let side of the business rather than the residential side of the overvaluations. So that's an interesting one. But to the point that was made earlier about, you know, if you want to buy. What we've done some research recently, and what we've seen is the seasoned or the God, what's the word I'm looking for? Tone, come on, snap. Well, let's start the other way around. The people who aren't buying, first-time buyers, right? The ones who are those who are committed buyers.
Yes.
The ones who know they need to do it. That's the difference in the market. They're continuing to the point of, I've got to do this. I'm moving for the reasons I need to move. I can afford it. Yes, it's more, but I've got to do it. As opposed to first-time buyers who are going, not yet. So that's what we've seen from research. Are you seeing the same in terms of your world?
Literally was looking at those figures yesterday. We've had a significant swing in the demographic of applications that we've seen in the last 6 weeks and the period before that. Those that don't need to move, first-time buyers, and to an extent, buy-to-let landlord purchases and things like that. They've really reduced. Massive increase in terms of resi remortgage, buy-to-let remortgage, PTs, things like that.
So, because this year's the largest ever year for buy-to-let remo, isn't it?
Until next year.
Until
next year.
and the year after that.
And the year after that. But next year
that.
is definitely bigger.
But-
and then we're all, you know, most brokers are doing 2-year fixes or trackers we know works at the moment. So I'd expect 28 to be even bigger.
And is remo outperforming PT in your worlds? Or was? I think it probably was. Maybe
is.
not so now.
Yeah, I haven't seen the last couple of months' figures, but it was. So 2025 definitely, 2024 no. I think what we had was all the lenders repositioning their take on affordability meant that it was a lot easier last year to do a remortgage versus a PT, whereas I think the previous years it was a challenge, so therefore the PT was in many instances the best option. I was expecting that to go even further this year, but we shall see.
And I think last year we've had periods of dual pricing and things like that, so it has encouraged people to PT. I think one thing that will be interesting to see that a lot of people have brought forward mortgages or remortgages and securing rates for 6 months' time. Whether they will stick and whether people will move to PTs depending on what the market looks like for lenders over the next 6 months, I don't know.
How do you then, Tony, back to you, how do you manage that app to completion ratios? Because especially in this area of, you know, the mortgage charter where we can change the rate all the way down depending on whether it's 6 months or I know some lenders move to 4, is, you know, historically remortgage had come in about 5 weeks before the actual remortgage need to happen. The PT had come in about a week before, whereas now it's booked 6 months in advance. It could change 4 times or not even come to you. So how do you work that through when you're managing your flow to go, well, actually, we've got X million in before we'd expect Y, now it's Z?
Good question. Good question. It's a bit of a juggling act and a balance. It's, you know, I can't really give you a fully seasoned answer because I try not to involve myself in that. I let other people deal with that.
Yeah.
But it is a balance. And I suppose I mean, I'll push it back and tie the question is, so a lot of this around certainty is about who's got control of that voice. So obviously we've seen all the news from the regulator around freeing up or making advice easier for for execution only. Have you seen more lenders trying to wrestle back business at maturity, like PTs, or what are you seeing as as distribution?
Not seeing. I don't think we're seeing anything different. The letters still seem the same that go out. They might go out maybe a month earlier, but we campaign for a long time to make sure that it said and refer back to your original broker if that's how you submitted into the lender. I think the challenge is for us as an intermediary community is to make sure that we've got in front of that customer or let them know you will be getting a letter from your lender in the next 2 weeks. When it comes, give me a call.
Mm-hmm. Yeah,
that's the bit where we can't sit there and throw bricks at it and go we don't like that and do nothing.
You've got to be proactive.
We've got to be
absolutely.
proactive.
Yeah. I mean, one of our processes is we contact at 7 months because we want to get ahead of those lenders that are going out at 6 months. But we've also experienced certain lenders waiving their ERCs to allow clients to PT so that they're not left in a worse position when they come to the end of their product in a few months' time. So it makes it very difficult for us to look at alternative products.
Do
from
they
the whole
let
of the
you
market.
do that?
No.
Right, okay, that's
Yeah.
not good. Because there is one lender that will let you do that as well as
Yeah.
the
Right,
customer,
which is
fine.
if it's
fine.
equitable,
Yeah.
Because then it's still
fine,
back
isn't
to
it?
advice of the advisor
Yeah.
saying,
Yeah.
actually, you are better coming off it 2 months earlier and taking this.
Yeah. No,
Yeah,
absolutely.
no, that's interesting. I mean, we're really clear. We're 100% intermediated on the way in. So our recommendation, ours is straightforward. Our letter just says your maturity, blah 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 blah. You can do it yourself if you want, but if you do, you lose any protection that you want in terms of making that decision. So we recommend you go back to a broker. Or if you don't have a broker, we can help them find one. So it is very much on, to your point, the brokers being in front of that and maintaining a relationship with that client. Is there more of that now you're seeing? Because it kind of used to be a fire and forget in the mortgage market, and you didn't really do that continual review. Are you seeing that brokers are getting more used to checking in to see how life's getting on with their clients over that term of that first initial period?
Yeah, we see that. It's a changed market. It's a significantly more competitive market than it ever has been. Not just from sort of the lenders, but also from other brokers as well. If you're as a broker not moving fast enough for the client, there's plenty of other brokers that will. But we use at John Charcoal, we use a platform for client engagement anyway, so that clients get a monthly email anyway, just reminding them that they're going to be coming to the end of their tie-in period. These are the products that are available.
Yeah.
Reach out, and we have on the same platform a different narrative throughout the whole period of the product, just to make sure that if people do want to have a change of circumstances, want to move house, whatever, we're the people that they think of.
I think there's a lot more communication with clients. I'm not sure how much more physical communication, but I think there's a lot more digital communication during that journey. And I think because we have swung back more to 2 years from 5 years over the last few yeyears, the contact's a lot. It's quicker than it was.
Yeah.
Whereas before, if it was a 5 year and you don't go back until 4.5 years, well, you probably are going to have lost them.
Yeah.
So I think that is working. I think it is getting better. And I think when you look at the data, so purchase remortgage is about 85, well, probably 87, 88% intermediated. PTs is about 68, but it's growing every year. It's growing.
Yeah.
So there's still a long way to go for us to
get that
to
parity.
equalise
Yeah.
it. So I think
Yeah.
there's still a lot of work to be done. But it is that communication, but that communication goes everywhere. So for the question you didn't answer, Tony. One of the things that we need to do as an intermediary again is if after a while we've decided to PT it and not remit, we need to tell the lender that one's gone, because I think we need to help you clear out your pipeline so that you understand. Because what we need to know is that might affect your pricing on your next range if you still think you've got this money left or not. And I think for the future clients, we need to be telling you what's happening with your current clients as well.
Yeah, it's quite interesting because a lot of our distribution are asking for more clear information on which of their original cases they did are coming up for maturity. So I think to your point, that is something that is going on. So I understand your question better now. So I still probably can't answer it, but at least understand it. I'll come back to you later. Cool. Look, let's move
I
on.
can have a go. Shall I have a go?
Hey?
Shall I try
Yeah,
and
please,
answer?
Lee.
But
Please.
the only reason it's difficult with us, I think, in some ways, because a lot of the reasons that they've used us compared to, say, the high street is not because of rate. So what we don't see is a lot of drop off because of rate. What we do is we following up, and we've changed our process where we are constantly communicating with those cases that are at offer, that we're waiting on solicitors or completion to go through, and we've upped that communication. We should probably change the title of this to communication being so key, but yeah, so that's what we're doing. And then we aren't seeing as many drop-offs from rate because of the fact they've used us for a different reason, which is what we were highlighting before around criteria. So there doesn't seem to be as much of a drop-off. Our conversion rates, once it's been offered to completion, are still really high. I haven't seen a drop from the data that we've seen. So I mean, that's probably why it's a challenge compared to, say, the high street lenders, where they are completely rate oriented, not completely, but they are rate orientated. They probably are seeing a lot more measured approach to what's going on. But yeah, the challenge always is when it comes to the pipeline, is it going to complete, and communication being key. And I think from what we were talking about before, communication being so good from a digital point of view, I think the old-fashioned pick up the phone and actually getting an answer, and brokers and us doing more of that is key in the current environment. Absolutely. I use myself as a good example. About a few years ago, I bought a house before I met my wife. I then had loads of communication from a broker. 3 years later, I had a 3-year fixed. If that broker were to have picked up with me, I would have sold my house, moved in with my wife, and we'd be expecting a child. Obviously, it's a few years ago now. But when they did pick up the phone to me, "Oh, are you interested?" No, because I've got a new house, a new mortgage, and my insurance has all changed. But if someone picked up the phone and said, "Hi, how's it going?" I would have had a chat about it. But my emails going into my personal email is pretty much junk to me, unless I absolutely have to, because my work emails is busy enough. So I think that's the key thing. It's just that old school picking up the phone is so key as well.
Do you think you would have had a meeting? So if somebody's got a 3-year fix, like you say, and an advisor says, "Oh, I'd like a yearly review with you," how many customers do you think would want that if they don't think anything's
But if I don't
changed?
personally, I think that if I don't want it, I'll say, "No, I'm all right, it's all good." But ultimately, there will be times where I'm like, "Actually, that's a good time to talk about it," right? When I was expecting my first child, I remember being, I was with a network, which I won't say because it's like swearing on this, but I was with a network, and we just gone through some protection masterclass, and I remember driving to somewhere to give away the network in a minute. But I was driving, and I instantly went, "I need insurance." If a broker had rang me even 6 months before that and said, "Do you want to have a review?" I would have picked up with that broker, because I had literally no relationship since probably about 2 years, 18 months, 2 years. I think you just need to give that option.
Yeah, the key to that question, in my view, is how is it set up by the advisor in the first place? If you don't give them a reason to want to talk to you, then you're not going to, because you don't know what you don't know.
Yeah.
You've gone to an advisor for that reason. But if the advisor says, "Look, it's important that we stay together because, shit happens in life, and it's important that at all points you've got, the appropriate cover, and if I can help you with that or direct you in the right place, I can." So I think that way you're more in tune to go, "All right, cool, that's good. I'll have that chat."
I think it's the second point rather than the first point, because the first point sounded like you wanted to sell something, and I think that's the risk of a customer. If you go, "I want a yearly review," and they feels like it's just a sales pitch every year, they're not going to have the second or the third one, are
absolutely.
they?
Yeah.
So I think maybe it is a 15, 20 minutes.
Yes, you don't call it a year annual review.
No,
I mean,
it's
I'm just picking up. I just want to see how you're getting on.
I'm just checking in. Look, I mean, ultimately, and as an ex-advisor, whatever I used to talk about, I was saying, look, my job is to give you choices. Whether you take them is entirely up to you, but I'm just going to listen to what you want, replay what you want back to you, and then you decide whether you want to do it. So that's how I used to approach it. And then if people go, "Okay, it's about me, not you," then hopefully they're more interested in listening. But we'll see. And funny enough, that comes in really nicely to the next subject, which is about the importance of broker development. So we've looked at this at Qualifications beyond CeMAP. So I looked at this one because we've got the LIBF specialist lending practitioner, which Martin, you were one of the vanguard in bringing this to the world, and Lee recently being one of the most recent people to get it. So I suppose the question just is, why is that broker development so important?
Because things change all the time. You know, I've been a broker for, I've got my CeMAP back in 2001. So, of course, the market is completely different since then. And if I hadn't kept on top of my knowledge, CPD, and additional development, then actually I wouldn't be able to provide a decent service to my clients. The market has changed so much in the last in my time, 20 years. You know, clearly advent of the internet, comparison websites, AI, and there is absolutely a place for those platforms. There are some very vanilla clients out there that really don't necessarily need advice, and hence the reason you know, the FCA is looking at making it more, making it easier to go for execution only process journey. However, in our experience, and at John Charcoal, I would suggest that we probably do attract a more complex client, that actually most people are now more complex. You know, you've got a lot of people that have got portfolio careers, multiple income sources, aging populations, a demographic, and so there is no such thing as a straightforward mortgage client anymore, and you need to be able to stay on top of that, and being able to be knowledgeable, confident in what you're talking about, in your own skill. You are a professional. You need to sort of take responsibility in developing your own skills.
Yeah, and I think another lender who I mentioned did a study, and I think they've said that in the last 3 years, 5 million people now have a side hustle to help pay for their mortgage. That's not how many people have got a side hustle, just need it for the mortgage. So all that complex is right. And I think if you then look at, and one of the really reasons for specialist property finance part was, we were seeing a lot of landlords are looking into different areas now. They can't get the yields in their normal ones. So they've gone into HMOs, they've gone into multiple occupancy, they've moved into semi-commercial, they may be doing a bridge or a development to actually turn something in to then rent out. And our view was, you know, if the advisor community doesn't follow their client bank, in this case the landlord, somebody else will. So part of setting that up, and it's great that Lee's passed it, was to give that entry level, because people were saying, well, how do you do it? It's complex. Is it? Yes, no. It's just different terminology. You just need to understand the terminology. So that course is to give you that foundation level to understand how the market works, what the terminology is, so that you can start having those conversations, whether it's with your landlord clients or even with the lenders, and understand what they're after back, because that's the key bit, and that knowledge, because if you don't, somebody else will take that, and if they take that, they'll probably take you the vanilla buy-to-let at some point as well. So I think it's all about that, how the market moves, whether it's the technology moves to do it differently, whether regulation moves, or whether your client bank's different.
And what's the take-up been? Do you know the figures on
the last time I checked, I think there was just over 1,500 people had downloaded the course, and I think we were at over 500 people had passed it. So the next bit is to get more to pass it, and a lot of that is because people just haven't finished going through it yet. But yeah, it's picking up, and we've seen it more and more. I think I've seen 3 this week already on LinkedIn of people putting the certificate up.
Fantastic.
Showing it. So
I mean, to me, so obviously, Lee, you know, there is no requirement in your role to do that, but you've chosen to take that qualification. Do you want to just explain why that's important for lenders and lending staff to develop that side as well?
It adds on to what you were saying, Simon, about the fact that the market's evolving, and if you're a lender in that space, being able to communicate and work with brokers and looking at opportunities for where we can explore, I think you have to have that foundation. For me personally, in an evolving market, development of myself is really, really key. I can then impart that onto my team. I thought that the course was really well pitched for those that are either looking to go into it or have been in it, that actually might not have been using the right terminology, or might not, because it is so different advisor to advisor, even let alone lender to lender. So I think it's a really good way of sort of standardizing a little bit of what can be at times a little bit, I a bit mixed. So I thought the course was fantastic, which is why I was really, really keen to do it. But I think from a lender point of view, if we're truly on about adding value, we have to develop ourselves before we can impart that onto anybody. At least I can now talk about this course and the benefits of this course with brokers, with firms, with my team, so they can do the same. Because actually, development isn't just about understanding someone's proposition and saying that I'll give you the best advice. It's knowing the market. It's knowing where the direction that market might be going in, and being able to make something that can feel complicated simple. And if we're not developing ourselves, then how is that possible? And that's why I felt like at times, I look at development finance, you can have a phrase for heads of terms, different parts of the process. I remember looking at it when I first started looking at it, going, blimey, are we at this point? And then we'll go, oh, no, that's terms later on in the process. I'm like, no, we're here. We've said terms here. And that still happens now. So, I think that from our point of view, the more that we can support brokers is really, really key. That's why I was so keen to do it. So, plus it was nice to pass it and realise I was actually reasonable at what I do. So
It was a surprise to me too.
No. That's why I didn't tell you I was taking it.
Yeah, good point. What with the feedback we've had from both the advisor and the lenders have took, because we've had a lot of underwriters take it, is I understand the other side of the journey now, because again, lenders, underwriters see the case there, they haven't seen how it got to that point, and vice versa, the advisor's not understanding the lens that the underwriter's looking at. So again, we've had that good feedback that it makes it a bit more clearer. I
mean, even just, it doesn't have to be the most complicated either. That's what I was getting from it as well, is even just buy to lets, that is almost a given that past CeMAP you jump into the buy to let game. CeMAP doesn't really cover a huge amount, whereas this does give you a decent platform to go, I can at least discuss with a lender, like you say, and have a good quality conversation. Whereas I feel like sometimes when you pass CeMAP, you're in the deep end, unless you're with the right firm, with the right support, you're in the deep end. But the person who's passed CeMAP is like, oh, I'm qualified. I can give advice.
Yeah.
And
it's like learning to drive.
Yeah.
You passed your driving test, but it really doesn't give you the skill to drive
Absolutely.
well.
No, and but it still evolves anyway. We're now seeing, buy to let limited company was niche 4 years ago. Now it's normal. So we moved into we're now seeing people buy shares of the limited company rather than the properties in the limited company. Yeah. So that's the next stage of, well, how do I advise on that then? What lenders will consider that? What do I have to do? What's the legals look like? And I think everybody's learning this as we go through, but it just shows the evolution of those products.
It's really good. We are rattling through the time. So, but I do want to ask this question, and then we'll finish on our usual roundup of our all getting our crystal ball out. But diversification is a very well trodden word over the last couple of years in terms of brokers and the need to diversify. And we get, I think it was certainly the buzzword last year, Lee, wasn't it? At every event that we attended was all about diversification. How do brokers broaden their experience and their propositional support for their clients? So is it a buzzword? What are you seeing, Simon, at Charcoal in terms of brokers diversifying?
So I think it's about having the support in place for those advisors. I think as a business, we're probably fairly diversified anyway. I think it's also from an individual broker's perspective, knowing where you can help and where you can't, so that if in the event you can't help, you need to sort of pass say, for example, that client to somebody that can help to ensure that client journey is as good as it can be. I think probably from what you were just saying, it shouldn't be a knee-jerk reaction. It should just be something that, from an individual broker's perspective, they do over time, additional qualifications. They'll identify in themselves that maybe there are certain areas to their knowledge that they could improve, and that's something that they'll go out and do themselves.
I think it's sometimes we should be giving holistic advice. And when we say diversification, people go, well, you need to sell protection and GI. I'm going, well, that's not diversification. That's doing.
That's your job.
And if you say you're a mortgage and protection advisor, that is your job.
Absolutely.
But it doesn't mean to say you either like it or you're good at it. And I think sometimes we're at work a long time and we want to enjoy it. So if you don't enjoy protection or you don't enjoy GI and you just like the complicated of the mortgages, because it is, that's fine, refer it. But at least you still make sure the client's getting the holistic advice.
Absolutely.
Just make sure you've got those referral partners there so you can concentrate and actually enjoy coming to work, not thinking, I've got 2 protection interviews today, I'm not comfortable, I'm not sure about it. Well, no, give it to somebody else to do it for you. So you've still got that client, you've still got control to a certain extent, because we never control a client, but you've got control of where people go rather than or giving them options of where to go that you can say that you're comfortable with. And I'd say, you can say, I'm the mortgage expert and you're happy with I'm now going to pass you on to our protection expert. It doesn't have to be in the same company. It's back to the positioning that we said before, but I'd always say make sure you enjoy your job. So therefore, there's some bits you can't get away with. You've got to do the compliance. You've got to do the compliant bits. But when we're looking at the products, work out which ones you like selling and advising on. But just make sure that you've got the others covered somewhere.
Absolutely. I think for diversification as well is that we know a lot of networks have come to us saying we need to do more complex lending. We're light in that market because, those multiple income borrowers that you're on about, that's 18 million UK adults have more than one role, more than one income now to survive. So it's gone from niche to almost mainstream.
Yeah.
So there's a real desire and need for brokers to understand broader markets. And I think to bring the point to another diversification market, we ran something, it's a couple of years ago now, where we asked about specialists and asked senior distribution leaders to tell us what specialist lending was. And it was a good list, but not one of them mentioned self-build. So for us, that was how we helped them and educate them. And as a result, we've done so much more self-build, and we're seeing new brokers all the time using us for self-build. So that's the kind of diversification. And it's our, how does a broker get more leads coming to them? How does a network keep their advisors? How does a club remain relevant for their members in those markets, I suppose, is the key.
Yeah, you picked another one of my hobby horses there, haven't you? Yeah, we're very good as an industry to put a label on something, but not actually have an explanation of what the definition of that label means. And specialist is the biggest one.
Yeah,
you go to some events that this is a specialist lending event and they don't mention bridging, development, financial, commercial term.
Yeah.
Okay, so what do you mean? Well, we mean complex income. Well, it is specialism, but it's in the eye of the beholder again, isn't it? Of what it is, and to me, is it specialist lending? Oh, no, it's broken.
I mean, some sort of mortgage firms treat SPV buy-to-let as specialist, whereas, as you said, it's very run-of-the-mill now. So it's so subjective.
I think, Martin, it's the modern broking, isn't it? It's all of that. It's a broader spectrum. Lee, any thoughts on that before
I was going to say the only thing for me is that the amount of times I hear the phrase, "Oh, I've got that case that I've just had at the bottom of my tray," right, and I'm now getting to it. So to the point you were saying about do the lending you're comfortable with, and then have the partners in place that you can work with. I think for a lot of brokers, it's getting comfortable with the fact of knowing that that's the way forward. It's not a bad thing to refer something over. You've still got an element of control, but getting those referrals over sooner is so key, because actually not doing that, you're actually losing control that you have with that customer because they're already looking for an answer elsewhere. So I think that I'd love to see that phrase personally, or it's at the bottom of my tray, I haven't got round to it yet, gone. Where people have got partners that they're comfortable with, that they work with regularly, so that's not the customer journey that some provide. I totally get why it happens. I totally get why it happens, and I've been guilty. in the past of going, right, I'll get to that case, and another case comes in that's easier, I've placed that, and actually that other case, but I think that's where the partners and the market's evolved and is always evolving, so we have to have that in place.
That is so important, especially it's evolved over maybe even just the last year with the advent of ChatGPT, that clients will just go on ChatGPT, ask the question, ChatGPT will suggest a solution, and a broker as well. They will just contact that person. You know, you need to be as a broker, you need to be agile. You need to be able to deal with client inquiries quickly.
And your website needs to be good enough for ChatGPT to
Absolutely.
pick you up.
Absolutely.
So that's another
It
thing.
needs to say what you do.
Absolutely.
Which
and
a
how
lot
great
don't.
you are.
Yeah.
Yeah,
let
we talk
customers
about
do
that all the time. If your website doesn't tell people what you do,
Yeah.
you're not going to get found, are you?
It's back to that point as well before. If you put that you're a mortgage broker at the end of your footer, but you're actually selling protection as well, or advising on protection, well, the client's not going to know that, because you're not telling them.
No.
Yeah.
So when you raise it, they go, I thought you were my mortgage advisor.
Well, that's what we've found with South Build, is that we have these conversations, and the first thing we do is have a look through their website and have a chat through together of their website, and it doesn't say one word that suggests that they are even able to do South Build, let alone how they would approach it. So it's just something that, I know we keep going on about the website, but it is so key. Really is your advert to your customers.
Yeah, absolutely. Right, we are rapidly running out of time, but one last I suppose very quick reflection, all of you, or forecast. So what's the outlook for the second half of this year? What are your thoughts? Obviously, we've got sticky inflation, we've got lots of uncertainty, but what do you think? Simon, let's come to you first.
I think it still looks really positive. As Martin was saying, in terms of remortgages for this year, we're now apparently at the sort of the sweet spot in terms of post-COVID, mini budget interest rate retention remortgages. So if the first time buyer market isn't quite there, if the next time mover buyer market isn't quite there, then there's still business to rely on. And I think possibly one of the challenges that we might see is going to be around affordability. We have noticed already, just sort of circling back to the conversation around appropriate valuation, we've seen lenders look in more detail at contingency planning, making sure that clients have got that fallback plan in the event that there's a change of their circumstances. But no, I think it looks really positive, and I'm not entirely convinced that there will be the interest rate increases that have been initially suggested.
Good. That's one positive. Martin, it's come to you.
I'm always positive. It's just sometimes it takes you a little bit longer to find them. But no, I think it is. If you think you've been saying people are booking rates at 6 months out, we're already at the end of September. If you look at it in that terms, yes, there'll be some more to add in, and then October and December are 2 really big months for cessations as well. So you already know that 2 of the 3 months after September, we're going to get a lot of apps in the next 2-3 months for those as well. The bit we don't know is the purchase market, and I think that's the balancer. So I think it's going to be a good year. It's going to be a hard year. It's going to be a lot of rework. It's going to be stressful. And even last year, you talked to a lot of brokers, they probably had their best year financially for a very long time, if not ever. It just felt really hard.
Yeah.
This year started like it was going to be a really good year, but wasn't going to be as hard. It's just going to be as hard for a different reason. Yeah. But I think at the end of it will have been a good year, depending on what lens you're looking through.
Yeah. Lee?
I agree, obviously. No, I do think it's a good. There's a lot of opportunity out there, and I think that we've mentioned a few times, touched on communication being so key. I think, if I'm honest with you, I think from the lens that I've got with brokers that I'm speaking to and firms that we're working with, those that are really good with their communication and education, I think will have a very good year. And if I'm honest, those that don't, I think will really struggle this year. I don't think there's a lot of easy wins. So it's about being there and showing that you're there and you're genuinely there for your customers. And the only way you can really do that is communicate and educate, especially when there are lots of twists and turns in the market. The one person you want the customer to fall back on and say, what's going on is your broker. You don't want them to be turning on BBC or any other channel and getting some advice or some guidance from the news there, because it doesn't tend to have such a positive story. So I think that's really key for me, for those brokers, for this year. But I think there's a lot of positivity, a lot of opportunity still out there. It's just changing your lens to what was probably 3 months ago, and making sure you're looking through that.
Good.
one.
Well, look, it's great to see 3 positives, and I'm positive. I think the other positive for me is, again, the current scenario, the market demonstrating its resilience, lenders and brokers working together. I think there is that closer working than we've ever had, as we both start to understand each other's pressures and dynamics. So it's great to see this market. It's a confidence market, but I think confidence comes not only from the external macro, but from the internal and how we're learning as a market and how we can do things better. So I think it's a really positive world. And on that note, I think that's it. That is that 56 minutes, which I've overrun, but it was so interesting I didn't want to stop it. Thank you so much. So big thank you to our guests, Simon, Martin and Lee. Please do follow us on LinkedIn. That way you can find out about all our updates and also when the next episode of the Mortgage Conversation will launch. Also, don't forget to follow us on your favourite channel, so you can get notified when the next episode is released. If you like watching podcasts and you like watching us, then head to Spotify or YouTube. They're probably the most best. Great English for that one. Yeah, big education for that, costs a lot of money. They're probably the best ones to watch. As ever, I'll give you my health and safety warning. If you are going to watch it, please don't do it whilst driving or operating heavy machinery. Got that bit out of the way. Well, that's it for another episode from us. Actually, this episode will launch on the 1st of May, so keep an eye out for that. So it's a big goodbye from me, and it's a big goodbye from them. Goodbye.
Thank you.
Goodbye.
Bye.